It's a shock move. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, China escalates the trade war with shocking ban on U.S. goods, leaving many wondering how President-elect Trump will respond after he takes office in January. I'm going to show you what China did and why it's a desperate move, because the question is, can China's economy handle retaliation? I'm going to show you why they can't. Now, let's over to Bloomberg. We picked today's story up with a headline, is China sets precedent by banning others from selling goods to the United States. And this could be viewed as a move to make sure the United States knows that we are their #1 trading partner when it comes to Asia. But there's an entirely different reason behind this move, as you're about to see. And it's all about escalating the trade war. Companies and people overseas will be subject to those restrictions, the Ministry of Commerce said on Tuesday. Any organization or individual from any country or region that violates the provisions and transfers or provides relevant dual-use items originating in the People's Republic of China to organizations or individuals in the United States will be held accountable according to the law. And what's happened here is that China has already banned the sale of goods to the United States, and all that's happened is exporters have simply sent it to another country who is then in turn sending it to the United States. China now putting their foot down, saying that they will prosecute people to the extent of the law if they're engaged in such behaviors, in an all-out attempt to completely cut off the United States from critical goods that we need every day. The president said he move amounts to an escalation with the U.S. weeks before President-elect Donald Trump takes office. China is a top global supplier of dozens of critical minerals, and concerns about its dominance have been mounting in Washington ever since Beijing placed initial controls on exports of gallium and germanium last year. And the problem is we need this for particularly the electric vehicle and the electrifying revolution that's happening all around the world, and we don't have an immediate answer to where we're going to get these. China then threatening to put a halt to all of our advances in that technology by cutting off our supply. The question I want to know from you is, how do you think President-elect Trump will respond? Do you think he'll just let this pass through? Do you think he's going to come down on him hard? What's he going to do? Weigh in the comments below. Love to hear from you, because in recent years, the Chinese government has been strengthening its toolbox to push back against U.S. sanctions and trade controls. Now, one of the challenges here is from the U.S. economic standpoint is we're already seeing inflation being a problem. We're seeing wage growth slow. We're seeing the labor markets start to get soft as jobs are lost and there's no opportunity for U.S. workers to come off the unemployment line. And what China's trying to do here is drive prices up, particularly in electric vehicles, because they've got a ton of them to export and they're far cheaper than their U.S. counterparts. And what they're hoping to do is drive U.S. manufacturers right out of business. And the way they're doing this is through their unreliable entity list and export control law that they put on place back in 2020, and the anti-foreign sanctions law that came out in 2021. It also passed a national security law for Hong Kong, which claimed jurisdiction over acts committed outside of China's territories. So what we can see is major pushback from China here, and as President-elect Trump threatens to escalate the tariffs, well, what we're seeing from China is they're not bowing down, they're standing strong. The question remains, can their economy even handle a retaliation? Well, stay tuned. I'm going to show you why they can't at all. And Nvidia was then in turn hit with China probe and global tech war escalation as China goes full throttle against the U.S. The move against Nvidia is Beijing's latest riposte against escalating U.S. technology curbs, coming just a week after the Chinese government banned exports of several materials with tech and military applications. And this is a huge blow to Nvidia, which does about 15% of its business in China. But something that else is critical, if you're looking to expand your toolbox when it comes to trading and making money, check this out. Just the other day, we put this trade out to our subscribers. This is a Mexico ETF. We said buy it open right here, and look, it was gone up ever since. And here's the actual notes. Back on December 5th, we told our subscribers, look, it closed over its 10 and 30-day volume profiles. Buy this at open. Here's your upside target. We even give you stop losses, and now this is headed even higher. And how do we do that? We do it through looking at the machine positioning each and every day on our CTA Timer Pro. Hundreds of billions of dollars are traded by machines, and we scan their positioning against the market, because when the market's rallied and and they're going the other direction, you have to turn around and become big buyers. This flagged on our reports as a high value trade, and sure enough, it's delivered. And what do you get? The daily report, the tradable signals. I go through the trades and give you my opinions on them. We've even back tested our reports to prove how great they are and that our trades work and give you winning results. We give you risk control levels. We track all our trades and returns. You get a full weekly update. You even get disclosure on my trades. I actually trade my own reports, and you can find out what I'm trading and why, and you get a 30-day free trial. Jump on those links in the description below and start making money in the market. As China's consumer inflation weakens ahead of key economic meeting, and this puts a big question, is can China's economy handle a retaliation by President-elect Trump? Because what we're seeing here is China stand firm. They're going toe-to-toe. They're banning exports. They're banning people who are trying to circumvent their laws and threatening them. They're coming after Nvidia. Of course, this is a big key company, and of course, the U.S. stock market as investors have piled in, threatening to perhaps bring Nvidia stock price down, and China's being very aggressive here. The problem is their economy is weakening, and perhaps President-elect Trump won't have to do much to send them spiraling into a recession. The consumer price index rose less than forecast, 0.2% from a year earlier, the lowest since June, while core inflation picked up slightly. Now, many people, particularly here in the United States, believe that inflation could rise amid slowing demand. And yet what we see in China is that demand continues to weaken. And yes, inflation can rise in a transitory rate, but what happens as demand continues to decline, inflation eventually follows. We're seeing that happen here in China. But the worst part is factory deflation now has extended a 26th straight month. So you talk about Beijing's ability to stand up against the United States and go into a full all-out trade war, and they have virtually no margin for error because their economy is getting weaker. So what do we see in the factory level is 26 straight months of the global economy slowing. We're seeing demand from all other parts of the world decline, and this is critical because, again, China, world's largest exporter, their manufacturing base is actually completely tied to the demand from all over the world. Though the consumer price index recorded a slower drop of 2.5%, that's right, put a negative in front of that number, compared to October, giving some hope that perhaps deflation in the factory sector is getting better. The reality is it's still declining, and this has a huge impact on U.S. consumer prices at a time, again, many people believe that U.S. inflation is going to rise or remain sticky, but yet when we look at what's coming out of China in terms of deflation, well, it's telling us everything. Because remember, China exports deflation, the U.S. exports inflation in terms of the dollar. But look at goods. When we talk about import price index from all industries in China, this in red against the consumer price index in blue, both on a year-over-year rate of change. And what we can see very clearly is that China started exporting deflation right around 2023. And what happened? It started to put downward pressure on the consumer price index. And as deflation continued down, many people started to say, well, look, inflation in the U.S. is magically sticky. But what happened? No, it wasn't. What we see is a further decline in demand from U.S. consumers amid continued deflation in Chinese goods is telling us that consumer prices here in the U.S. are headed lower. And we can go back and see that relationship during the global financial crisis. Input prices came crumbling down and went into deflation, as did the U.S. consumer price index. We can see around 2011, it starts to decelerate. That puts downward pressure on the U.S. consumer prices. Once again, going into the pandemic, you see just in late side of 2018, deflation take hold, puts again downward pressure on U.S. consumer prices. The question then becomes, how does China turn all of this around? Well, they've got a huge problem. They're willing to go toe-to-toe with the United States here at a time they have very little to stand on because their economy is falling apart. And weaker inflation may intensify calls for additional policy stimulus in December. And here you can see consumer prices slowing as producer prices continue to fall. Many people say there isn't a link. There's a very clearly established link where you see producer prices go. Consumer prices eventually follow. And the People's Bank of China is expected to continue easing monetary policy by cutting interest rates and the reserve requirement ratio, which will free up cash for banks to lend. A reduction in the reserve ratio is widely expected in the coming weeks. Some Wall Street banks also forecast the biggest interest rate cuts in a decade next year. And what we can say is this doesn't work. We said this when China was going to do it, when they announced they're going to come out and cut interest rates and try to focus on easing at the bank level. We said, look, it's not going to pass through to the consumer level. There are other factors here that these central banks and governments do not understand of what it takes to get consumers to come out and spend. In fact, that lowering interest rates that every central banker thinks magically works, here you're seeing in real time, they do not work at all. And all it's going to lead to is further cuts in the reserve ratio. But remember, this is all a reactionary function. The central bank in China is reacting to a slowing economy. It's not the other way around. They're not trying to stop the problem. What they're doing is they're simply reacting to it. But residents' ability and willingness to consume remains low. Expectations for private investment are still weak. The property market is still in deep correction. It's not about private investment. It's not about the real estate market. It's all about the Chinese consumer and their demand. They're unwilling to consume here, and that is the real issue. Their level of consumption has dropped, and you start to think about it, they are the world's largest manufacturing base. They export to the world. So when demand from other consumers all around the world declines, what shows up in the factory level? Less work. And what happens eventually is existing work levels decline, backlogs go away, and what do you see from consumers in China? They're starting to realize that they don't have the confidence that they're going to keep their jobs or get the hours they need to continue to consume. And so what do? They start saving and cutting their consumption back. And we can see evidence if you want to turn inflation around. Of course, this is what the PBOC wants. I'll show you what it takes. You have to get an increase in consumption. As we turn to the U.S. data here and look at the consumer price index in blue against advanced retail sales, less the CPI, or what's known as real retail sales in red, both on a year-over-year rate of change. And so here we can see consumption declines and then goes into contraction heading to the dot-com bubble, and that brings inflation down. That's exactly what's happening in China. Consumption is falling, consumer prices are falling, and factories are in deflation. You can see the relationship here. Again, starting around 2005, you see a slowdown in retail sales led to a decline in the consumer price index, which then briefly turned higher. Again, that transitory move to the energy, but ultimately that continued decline in retail sales brought inflation down. You see it again, it started around 2011 and led to inflation coming down again in late 2017. And then now for the last 3 years running, we have negative real retail sales inflation. Going to continue to come down. We should get an update on that this week. But if you want to talk about what China needs to do, what other countries need to do, it's get more money in people's pocket. It's not all about stimulus. See, they think, all right, if we just cut interest rates, if we just force the banks to try to lend. No, it's about giving workers confidence. They need to see an increase in pay. They need to see an increase in hours worked. And you see the link between total income, this shown as average hourly earning multiplied by average weekly hours of production and non-supervisory employees, that here of U.S. workers against the consumer price index in blue, both on a year-over-year rate of change. And you see the very clear established relationship. Where income growth goes, inflation falls each and every time. So there's another factor here, because even if you have rising income growth, you need to do something else, and that is create jobs. So just because there are workers seeing pay raises doesn't mean everyone's benefiting. Here's the other factor that the PBOC and Beijing need to focus on, and eventually governments all around the world, because when you look at the link between the unemployment rate here, again, this is the U.S. U3 unemployment rate against the consumer price index, that's still shown in blue. What you see is periods where there's rising unemployment. We have data all going all the way back to the 1940s. What you see is inflation come down. You see it happen throughout the 50s here. You see it happens in the 1970s, that unemployment goes up and eventually it hits demand, and you see inflation come back down. You see that relationship right now. So not only are we seeing real retail sales slow down, not only are we seeing income growth slow down, but we're seeing more Americans hit the unemployment line. We can see what's happening in China right here at home. Economic activity stabilized recently, but the recovery is not strong enough to boost inflation yet. That's the obvious part. It requires a much stronger fiscal push to get China out of deflationary environment. Well, what it does need is demand from consumers all around the world. And that's one of the challenges here. We come out of the pandemic. There was a lot of money borrowed and stuck into consumer pockets who spent big. We closed down factories and economies all around the world. And we went through a period where demand outpaced supply. And now that things are reopening and we don't have all the stimulus, what we're finding out is supply is outpacing demand. Ultimately, it's pushing economies all around the world right into a recession. And policymakers also elevated the importance of boosting consumption. And obviously, this is key. You got to get people to go out and spend, making it the top goal, potentially a sign the work conference will make domestic demand the priority for 2025. Xi's push for manufacturing to propel the economy has seen the U.S. and European Union complain that China is flooding their markets with cheap goods and prompted calls for Beijing to get its own consumer spending. So again, what we're seeing, evidence all around the world that supply outpacing, not just by a little bit, but far outpacing demand. This means there's going to be workers all over the world who are going to be on the unemployment line. And falling prices have undercut the economy's 4.8% growth so far this year, eating into corporate profits and pushing companies to cut investment as well as wages. So we talk about the U.S. and everybody says it's going to boom, but what are we seeing? Inflation coming down, wage growth slowing down. It's going to eventually impact company profit margins and the equity markets as well. And while the PBOC has slashed interest rates and offered more cash for banks several times, it's done absolutely nothing to turn their economy around, as authorities have found it hard to spur greater spending because the authorities don't get it. They think, well, if you just put some money in the banks and lower interest rates, everybody's going to come out and spend. But the point here is that China attempting to stand up to the United States, the reality is, it's possible. By the time President-elect Trump even takes office, it's going to be too little too late for China's economy. They're not going to be able to enforce it. They're going to be all out collapse mode, and any nudge back, and we know President-elect Trump is not just going to simply nudge China back. He's going to likely hit hard again. Love to know what you think he's going to do. You can weigh in the comments, and that may be the tipping point that sends China's economy into an all-out recession. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.